First of all, Bertha, thank you for coming to Boston and helping host the conference here with some of these great medical innovators that you just walk around the halls. So it's really something special with Mass General and the talent in this room. So these are about financial markets. This is about saving people's lives. So we got to keep that in mind. But look, the month of April so far, consumers stronger than it was in March. And so the consumers continue to spend money. And so people say, well, they're spending more because inflation has raised prices. The reality is the transaction volume is rising 10% over last year, which means they're doing more. You only go out to eat for dinner one time a night, not three. So you spend it. So you're seeing the money being spent. You're seeing the money in their accounts continuing to build, not go down, but build, which frankly poses a tougher challenge to the Fed, because how do they slow down a consumer-driven economy? And you heard Santilli say earlier, though, that the imports and stuff are strong because people are still demanding goods, and that's good final demand in the U.S. So we have this tug of war right now, but consumers strong, businesses are in great credit shape, trying to get goods and services sell, trying to get employees, and that's creating worry as to what happens after the Fed actually gets the rate structure up, and that's what you're seeing play out in the market. And oddly enough, when rates are rising, usually they equate that with bank stocks going up, but the debate about recession, we don't see any of that. Our credit quality is as strong as it's been. You know, the loan originations are as high quality as they've ever been.
You don't see it, and yet, you know, obviously one data point does not a trend make, but we certainly saw that first reading on GDP with contraction for the first quarter. We just saw ISM today disappoint as well, and a lot of those numbers were also lower as well. Could we be seeing some of the cracks? And if the Fed continues on this pace, the expectation is 0.5% this week, but some people are starting to say maybe in July they'll be doing 0.75%. Yeah. Can they engineer this, get ahead of inflation without putting us into some kind of deep recession?
You use the word deep, and they're trying to have a soft landing or a little bit of a bumpy landing, but not a deep landing. Obviously, that's the job they're trying to manage. The thing is, the statistic you talk about, the one that you didn't talk about, was the labor market. So last week, I think it was another 180,000 new claims for unemployment. If people say, well, that's a 50-year low, the labor force was 1/2 the size last time it was at that nominal number. So 80 million people working versus 150 or whatever it was exactly. And think about that. So on a relative basis, the labor market is very strong, and that's the difficult challenge for the Fed, is to actually get the labor market to cool down. Rising wages, 1.7 plus jobs for every job that's open, 10% underemployment in places needing workers in services side sectors. So that's going to be the tension. Now, simply put, from late last fall into the early part of this year, our experts and the Bank of America research team have lowered their estimates for GDP this year and next year, because as interest rates move up, it's having the effect. The Fed is yet to raise rates, and you're already seeing people lower their estimates in anticipation. So now they're slightly under 3 this year and slightly under 2 next year. That's down from probably slightly under 4. Last November, December. So it's come down in anticipation of rising rate cycle will slow it down, and that's what the Fed's trying to achieve. But the trickier execution here, unprecedented, frankly, is to have unemployment at this low level, job strength at this low level, wages at this high growth level, and trying to slow it down with only interest rates and balance sheet as the arrows in your quiver. And that's a trickier execution, because they can't create human beings to work. That's not the Fed's role, and that's our role, and whether it's immigration or bringing more people in the workforce. So that's going to be a trickier execution for them.
You know, one of the things we were just talking about on stage was about healthcare. You spent $2 billion on healthcare, and these days it's increasingly important, those benefits, in terms of trying to retain people as they see flexibility to move around. I wonder, as you work with providers like Mass General, what are some of the things you're trying to do to rein in costs? I know everybody says they're about outcomes, but that's a really big ticket to write.
Yeah, for us, if you think about it, as an employer of 200,000 plus people and the family members on our programs, and we're self-insured, if you think about it, the key is to get people to get themselves more well. And that's exercise, that's mental health, but it's also maintenance drugs. So our maintenance drugs and our plans are free for routine drugs that you can take. You get them mailed to you, it's all free. So you're driving down the cost to the employee, but you're also, frankly, providing incentive to stay on the maintenance level drugs. So whether it's cholesterol maintenance or whatever the maintenance drug is. And so what we're trying to do is figure out ways to help drive that. The second way we work with somebody like Mass General or other great institutions around the country is to provide access to treatments that we can provide for all our employees, that access to trials when there's a very serious case. Those are very unusual circumstances. The real way is to drive down the costs through lowering the cost across time. You're not going to change it for next year. The real big change right now is mental wellness, and we've been investing a lot. So we have 12 sessions you can get for mental wellness, the counseling sessions for free. And again, we're just trying to get people to use the system, because frankly, if disease progresses with a person, stress progresses, the health-related aspects of that, but also missing work and things like that. So it's all in our best interest to do this well, but it's all around getting a teammate to recognize how to do better for they and their family in terms of wellness. And then we kept the cost flat. Our teammates, below $75,000, $50,000 have paid the same for their health care costs. In 2011, they paid a day.
Wow, that's amazing.
Their copay, their deduct, all kept the same. And the reason we did that is just by driving costs out of the system. So our costs as a company are flat, and our teammates pay the same.
That's terrific. Tyler Matheson, I believe, has a question. Tyler?
Mr. Moynihan, I think maybe after your discussion of healthcare, I'd like to join your plan. It sounds pretty good, but I'm going to pull you back, if I might, to interest rates and particularly mortgage rates, which on the 30-year conventional are now in the fives, the mid-fives. We haven't seen that in many, many, many years. That's a breath taker for people who are trying to enter the housing market, particularly after we've been spoiled by rates in the threes and even lower. What's it going to do to housing, to home builders, and generally to the economy, because housing is such an important part of it?
Well, again, we're in a little bit unprecedented times, because we still have a lack of housing, even though rates are going up, which would generally curtail demand and are intended to curtail demand. So, that's why the rates, the Fed raises rates and the whole rate curve moves up and slows down, the cost of, or increase the cost of financing, slows down the demand for housing. But we just don't have enough units. I mean, and that's why you don't hear the home builders and stuff saying they're slowing down, because they're still selling the units. So all this will come in, I think the HSI last year to last month, I think it was up 20% or something like that. That's an unsustainable level, and we shouldn't cheer for that, because when did that feel like? The early 2000s. We should get it leveled back out. And yes, for an individual person entering the housing market today, 5% on a $300,000 mortgage is 2 points times $6,000, $500 a month more expensive. But to qualify for that mortgage, somebody would have to make, I don't know, $100,000 or round numbers in a household, or even more. It's not going to make or break the decision, but we'll make it more expensive and slow it down. But remember, people have to remember that is the intended effect of what they're trying to accomplish with removing the accommodation in a very strong growing economy with very low unemployment. They have to remove the accommodation, or else we're going to have inflation that will then put housing out of reach by price appreciation as much as anything else.
I have to ask you one more question in terms of banking and finance. Your friend, Warren Buffett, this weekend talked about his theory on cryptocurrencies, that he just doesn't really see the value in it. He doesn't really understand it. But you, on the other hand, also with Merrill, need to be able to meet the needs of some of your younger clients who are all clamoring to trade crypto. Where are you on that? And what are your thoughts about making that more accessible? We've seen Fidelity do it now.
At the end of the day, because we're a regulated institution, we have to seek approvals to do these things, and it's pretty clear right now nobody wants to be asked about these approvals. So what do? Our research team researches it, because not only the crypto itself, but the infrastructure, the NFTs, and all the Web3 and everything people talk about. Yes, Candace Browning-Platt and the team that researches that, so we do that, and that then feeds into our high net worth. We have very limited ability offerings in high net worth, very, very limited, honestly. But would you like regulators to be able to give you that, so you can? I think
are you getting demand from clients?
This system needs to be regulated. In the end of the day, if somebody gives you money and you store it for them, that sounds a lot like you're taking a deposit. And then and I think that people have to think about it. If it's really a currency, then the government has the right to print currencies, not other people. So people need to think about it. But until that regulation comes out, it's not something we can do much about. We can do futures and things like that, but very, very limited.
Terrific. Brian Moynihan, thank you so much for joining us. We really appreciate it.